All right, so welcome to one of our sessions, and we're still focusing on the basic accounting equation. But now we're going to focus on cash payment transactions and how they affect the basic accounting equation. So with the same with cash receipts transactions, cash payments transactions are very simple because we already know that whenever a cash payment is made, we're going to credit the bank account. Then after that, we're going to analyze the transaction to see which account to debit. But we already know that because cash payment was made, right, we're going to credit the bank account. But of course, this is a cash payment that is made out of the bank account. Sometimes you have a payment to a supplier made, but using the credit card. So that's not cash coming out of the bank account. It's cash coming out of a borrowing. All right. So let's have a look at some of these transactions that are cash payment transactions, and let's see how they affect the basic accounting equation. And like we said, the credit side is a given, right? So we have an entity called South Trading, and this entity is in the business of making furniture. So they bought furniture from a supplier, 15,000 Rand for cash. Now I wanted to say it's in the business of selling furniture, but whatever the case, I think you guys will not be confused. So they bought furniture because this furniture was bought for sale. We make that conclusion because the entity is in the business of selling furniture. So if they buy furniture from a supplier, then we're going to make a default assumption that they want to sell it, unless we are specifically told that it's bought for use. Then if they buy some piece of furniture for use in the company, then that's no longer inventory. But in this case, we bought inventory for cash. Inventory is an asset. It has increased. So our inventory has increased by 15,000, which is the cost price. Then we paid 15,000. So like all cash transactions, the bank account is going to be credited all the time if the money came out of our bank account. And of course, our equity is not going to be affected. Remember that only DICE transactions affect equity. Like when we have drawings, when we have income, when we have capital or expenses. But if we bring in inventory, and like I always said, this will change when we come to inventory management systems. But for now, all the inventory we buy is going to be an asset. So this means that one asset increased, then another asset decreased because inventory increased, bank decreased. So we have our inventory increasing by 15,000, then our bank decreasing by 15,000. We don't owe anyone as a result because we paid cash. So one of the things that you need to pay attention to is that sometimes where you need to have a word description, your examiners say put not applicable if that's the case. And where you should put in amounts and there's no amount, then they say put 0. So it's very important as well to understand. And follow the instruction as given. And then sometimes here where there is let's say in this case where there is assets increasing and decreasing, they normally say, for example, put the increase first, then the decrease below that. And finally, if there is not applicable, you put that last. So please always make sure that you read instructions. You also follow the format here that is given. Because like we said, it's not always going to be equity is equal to assets minus liabilities, because they can swap around, and then we come liabilities is equal to assets minus equity, right? So they can play around. So always be paying attention to the format. So we said this is going to debit inventory because this is the business, right? So it's not furniture. It was going to be furniture if it was for use in the business, but because this is for sale to customers, this is inventory. Now here's a case where we bought a chair and a desk to be used by one of the employees. The amount is still the same, but as you can see, this is no longer for sale to customers, but this is for use. So it's no longer inventory, although the business is still of making and selling furniture. But now this furniture that was bought is for use. So it's going to be furniture, which is a non-current asset. And we're gonna, because it has increased, we're going to debit. We already know that when we make payment for cash using our bank account, then the bank account is going to be credited, right? Like that. And we have our equity. There's no dice here, it's 0. But then our assets, we have non-current assets, which is furniture. So sometimes your examiners want you to split between current and non-current. And when it comes to equity, they want you to distinguish between income and expenses as well. So sometimes they say non-current assets, identify them, current assets, identify them. So this is furniture is a non-current asset, has increased by 15,000. We put a plus. Then the bank account, which is a current asset, has decreased by minus 15,000. And of course, both are going to be assets. We do not owe anyone anything as a result of the transaction, and so our liabilities are 0. So what happened here is that so we owe an entity called the Lillipati, right? So Mountain Dew is our entity that we're interested in. So Mountain Dew paid off its account with Lillipati. All right. So we always know that the bank account is going to be credited. But now this is somebody we have an account with, so it's a supplier to us. So we're gonna debit trade payables control or suppliers control or accounts payable. Also the name, the account of the supplier, because we also want to go to that account. All right, because originally we bought on credit, now we're just paying off. So of course the assets are always going to decrease by the bank. There's no dice transaction, but then our trade payables control has decreased, not increased, has decreased by a minus 23,000, right? Because what we owed has decreased. And if you want to do a check, it's 0 is equal to minus 23 minus 23. All right, so a little bit of mathematics there should show you that that's a 0. All right. All right, so in this case, we have the same entity, but what happened is they got a short-term loan. So during December 2023, they paid off 50% of the loan. My apologies here. I forgot to put the amount of the loan was 90,000. Somehow I did delete when I was preparing. So it's 90,000. So they paid back 50% of the loan. So that omission is not the substance of what we're teaching, right? So we already know that we paid this out of our bank account. So it's going to be right. But now what are we paying for? We're paying off a loan from ABC Bank. Not so. All right. So because a loan is a credit, is a liability. All right. Remember, liabilities increase on the credit side. But now this loan is not increasing, it's decreasing. So it's going to decrease on the debit side. So loan current liabilities is going to decrease with a minus, all right, 45,000. And our assets are also decreasing with a minus. And that's going to balance out if you want to check. Right. So what I did in this question is that I have the entity pay. So it could be any expenditure for the business. It could be wages, it could be interest expense, it could be fuel, telephone expense, water and electricity. All right, so we're going to credit the bank account, all right, and debit the expense. So whatever expense it is, if it is insurance, we debit that. If it is water and electricity, we debit that. If the payment was made for repairs and maintenance, we debit that. If it was for stationery, debit that. For cleaning, debit that. All right. Okay. So whatever expense, we're gonna debit it. But because we paid by cash, we're gonna credit the bank account. Let's say that we incurred this expense and we didn't pay. Then we're going to have accrued expenses here. Correct. That we're going to credit. Because remember, accrued expenses is not the same thing as trade payables control. Trade payables control is when we owe our suppliers who supply us with inventory for resale. But anybody else who we owe, we haven't paid, then it's going to be accrued expenses. Now there is a dice transaction because expenses are involved. So expenses decrease equity. So whatever expense it is here, it's going to decrease equity. But as we know, there was a payment out of the bank account. So this is a given. And we don't, as a result of this transaction, we don't owe anyone a thing. But let's say we didn't pay, all right? But now we owe, let's say MTN sends us a bill, we have to record it, 7,500, but we don't pay, we have to record it under accrued expenses. Correct. Or maybe under telephone payable, but it's still accrued expenses. So how will that have been recorded? Sorry. So it would have to come under liabilities, and we say our current liabilities have increased by 7,500. So our equity has decreased because that's an expense, but doesn't matter whether we pay or not. The expense is gonna, as long as we have been charged, all right, we're gonna record it as an expense that is going to reduce equity. Right, so what happened here is that, so the entity Mountain Dew used cash from the petty cash reserves, 5,000 Rand, to pay for staff refreshments. Now, staff refreshments is an expense. And if you remember your debt click, these are elements that you will debit if they increase. So there's been an increase in expenses. So that expense has to be debited, all right. And of course, we are paying out of petty cash. So our petty cash has decreased by 5,000. And equity is going to be reduced because this is an expense that we incurred. Our assets are going to reduce because the amount of cash we have has reduced. And we don't owe anyone any money. Then finally, we come to a slightly interesting transaction. Where in this particular transaction, right, what do we have? So we have a customer. Is it a customer? No, it's us, Mountain Dew. We paid 4,500 in full settlement of our account, right? But we owed Stella Limited 5,000. But Stella Limited allowed us to pay 4,500. So, okay, you are paying in time. So we are the ones who received the benefit. All right. So it's called settlement discount that we received. It's a benefit. And all benefits are going to be credited. A benefit is like income. So what this means is in our bank account, we actually did the actual amount that left the bank account is 4,500 that we actually paid. Right. But what are we paying for? We're paying trade payables, a supplier who we owed. Right. We owed the supplier, but now we're paying. So when we clear the supplier, we also write down the name of the supplier. And when we make an entry for the supplier, where we receive settlement discount, right, we put in the full amount, not just the amount paid. We enter on the debit the full amount being cleared away, being cleared off. So we no longer owe this amount, it's done, it's settled. How did we settle that? By paying 4,500. So this is the amount that goes out of the bank account. Then the difference between those two is the settlement discount. But in this case, it was received because we were paying, we got the benefit. So this is an income effect on equity. All right. So it's settlement discount received when we are paying a supplier and the supplier is happy, we're paying on time. So of course our equity is going to be affected because our settlement discount received will increase by plus 500. Then our bank is going to reflect that we actually paid 4,500 and we were clearing the full amount of negative 5,000. No, negative 5,000. So it's going to reduce what we owe. We've reduced what we owed. Brilliant. So that's it for now. Remember, if you have any questions, please do ask us. If you already in our groups, you ask on Telegram. If you would like to join our groups, free groups, you can WhatsApp that number and say which groups you want to join. If you want to join tutorial classes, the extra classes which are private and paid for, you are welcome to say that clearly on our Telegram groups. All right. Then we will be more than happy to help you.